Well, hello, my friends and members of the Society to Advance Financial Education for this, our professional investor segment. Joining us as a frequent guest is Mr. Jeff Garbaz of Quantitative Partners and Superstock Investor. You want to make sure to visit Superstock on the web. They offer some of the best institutional quality research for you, the normal investor out there. So you want to make sure to connect with Jeff. Jeff, I want to thank you once again for being on the program.
Hey, thanks for having me.
Okay, well, you and I have been a little bit shell-shocked, as most of us in the business have, with a market that came out of the gates really hammered this year. I mean, we knew China would be a problem and oil was coming down, but we didn't, I think, expect Saudi Arabia and Iran to go at an oil war. Looks like they have.
Yeah, it's a pretty interesting year. So with the first 10 trading days of the year, we've had 4 up days and 6 down days. Every single down day, we lost more than 1% so far. In 2 of those days, we've been down more than 2%. And typically, we only get like 5 or 6 days a year where we lose more than 2%. So this has been pretty extraordinary. And and only one of the up days, we gained more than 1%. So 7 of our first 10 trading days of the year, we had moves of greater than 1% or a loss of 1% or more.
Well, now, people you and I both know, like Peter Schiff or Dr. Mark Faber, have come out, openly and said it's a boom, gloom, and doom scenario. Do you think they're right? Do investors need to panic and run for the hills, or are we just in kind of a trading range here while people figure out what's going to happen with the Fed and with the economy as a whole?
Well, right now we're kind of back down at the September lows for the S&P. The August lows were the lowest lows we went to last year. September made a higher low, which is good, and we've come right back down to right around that September low on the S&P. The problem is the secondary and the tertiary indexes on the equity side, the mid cap and the Russell, have gone to like all-time new lows. So they've gotten pounded. But the thing is, you got to have some perspective on that. That typically occurs in most every single pullback that we get. We get those underperforming to a bigger degree. And some people are arguing, well, the S&P is going to end up down as much as the Russell or the mid cap, and I don't buy that. I mean, if you look at this year so far, the S&P through last Friday was down 8 and change, and the Russell was down 11 and change. And if you look at from the peak, the Russell's off like 23% from last year. That's a really big correction.
Well, and Jeff, am I right that some of the fundamentals seem to stay in place? The International Monetary Fund came out today with a revised forecast down, but they're still looking at 3.4% for global growth. We're looking at maybe 2.6% growth on the S&P earnings. It seems like the big multinational companies are doing okay, not knocking out of the gates with bang up, go home and tell mom numbers, but not bad numbers.
They're decent, and remember the thing, especially for U.S. companies, is the dollar had a rip-roaring time last year into through the first quarter, kind of first half of the year, and since we've been at a lower level. So any pressure, dollar pressure on earnings is actually, if the dollar comes in, it'll be a big boom to earnings, not a negative. And I think a lot of people are not looking at that. A couple of people have talked about it, but it's something that's it's been widely missed by a lot of people as a potential positive.
Well, I wrote an article for Epic Times, and I was talking about that there are good things. I mean, there are some geopolitical issues we all know we need to be watching from the Middle East and from China and Europe, but we do have some relatively good fundamentals in corporate America. They've spent a lot of time over the last years buying down their debt, buying back their shares. I think we're trading right now at something like 17 times on the S&P. It's not cheap, but it's certainly not an egregious overvaluation.
Now, as a matter of fact, last Friday, Leon Cooperman, who runs Omega, who's a pretty well-known investor, had a really great point about why we're probably not going into a bear market, because most bull markets end in euphoria, and we haven't gotten to euphoria.
We're far away from euphoria.
No way. We haven't even gotten there. It's as a matter of fact, we're still in this environment where it's like the quarterback has been sacked so many times, he's thrown the ball away just so he doesn't get sacked again. And that's what a lot of investors are doing right now. They're throwing the ball away and kind of giving up and kind of missing the bigger perspective. I mean, the one thing about now that's positive is, and I keep coming back to this: buy low, sell high. You want to be a buyer when there's blood in the streets, and when everyone else is buying the crap out of stuff, and you made a lot of money. Start taking your profits on some things. So we're almost at a point where there's potentially some good opportunities here.
I think what you're saying plays into something I've spoken about often. That is the world of buy and hold and set it and forget it investment policies are gone. You need to be actively trading in a market like this. To your point, get in when it's low and get out when it's higher.
The best analogy I've heard of this ever is from Phil Erlanger, who I work with, who has an institutional following and an individual following with his Good Morning Wall Street and Erlanger Chart Room. And he basically says, what's the definition of long term? And if you ask a typical person that, they're going to say 12 months, 18 months. And the answer is no, neither of them. The answer is it's the length of time it takes a move of magnitude to occur. So if a stock has done nothing and all of a sudden it moves 40% in 3 weeks, guess what? You just had a long-term move that was made. And so you as an investor have to understand how to take advantage of those things. I mean, good example, last week, Celgene got down to $100, and then the next day, people realized that was an overdone, and it was at 106. It moved 6%. So if you captured that correctly, you did a great job. And I looked at the year-to-date returns for the first 2 weeks, and it's nasty. The number of stocks that are down more than 10% for the year, and even now 20% for the year. It has just been. I mean, it's getting. I have a term I like to use. I call it stupid cheap, and I really feel like we're starting to get to stupid cheap.
Yeah, people are forgetting that, the economy's not going to crash. I think so much of the media now feeds on blood in the streets, and it just gets people's minds in this pessimistic attitude. I haven't seen it this bad since the late 70s.
Well, look, there are some things that could cause some really big problems if the price of oil continues to go lower. But, I mean, people are now calling for $20 or $10. It's stupid. I mean, like, we're not going to $10, sorry. And when you look at the rig count has fallen by like 1,500 in the last year in the U.S., so rigs aren't being done. I saw a picture of Cushing, and they showed the tanks from above, and the tanks are empty. So, like, we're cutting supply. It will ultimately have an impact. I mean, it's Econ 101. If you cut supply and demand stays the same, what happens? The price goes up.
Well, and is it not true that we're going to see some ripple effect of lower gas prices in grocery stores and consumer products? So there will be an ancillary benefit to this. It's not all bad.
Maybe not. I mean, maybe the deal is that the individual is just continuing to save, and the individual's been hit by certain things, costs that are out of control, like the cost of healthcare, that have tapped them. So we haven't seen that spending, even though we're down at like, here we're $1.71 a gallon right now.
So this might just give a less credit card debt buildup than otherwise would be there.
Well, I saw a bunch of charts comparing this against '09, and there's no comparison where we are in terms of either as a country, in terms of how corporations are doing, or the individual.
Yeah, we're totally different. We've got a different set of structural problems.
10 times better shape. Yeah. 10 times better shape.
All right. Well, Jeff, tell me, how have the models been doing? Because as people know, we run the Safe Investment Clubs. And if you'd like to learn more, please write me at steve@safefinancial.org. We use a lot of super stock research and Good Morning Wall Street research in these clubs. So, Jeff, what's been happening there?
So I'm just kind of pulling this up. I'm kind of looking. So last year, our super stock model portfolio, we finished the year up 5.63% when the S&P was down. That was great.
That's a spectacular number. I was mentioning in an article I wrote this week that even the hedge funds this year averaged about 5%. That's a really good return.
Without any hedge.
Right.
And so this year, though, we've been hit a little bit more because some of our large cap names have kind of taken it on the chin. We're down about 8, which is what the S&P is down. Now, we still have 3 positions of cash, and so that's 25%. We got 25% cash, which is the same amount of cash that we have in market crash right now. So we were down a little less, and then we have a short position which rebounded last week. Chipotle, I'll talk about that for a second. So their CEOs, the CEO and the president, go make a big presentation. Institutions take it back up, and then what do these guys do on that Friday? Last Friday, when the market closes, they announced that in February for an entire day they're shutting down every Chipotle around the country so they can do the preventative type of food action. They
publicize their own problems.
It's unbelievable to me that those guys made that speech last week and then on Friday turned around and did this. I don't understand how they can do that from a corporate responsibility standpoint. The shareholder lawsuits are going to start. The stock's down another 2% today, so that's kind of good. It's starting to fall apart.
Do you think Chipotle will survive this?
I think it'll survive, but I think that literally, I think we might be able to make 30 to 50% on the short position.
Well, and that's something I've talked about with our members a lot. You can make money either direction in the market. I don't care if it goes up or down. You just have to have an estimate of where you think it's going to go. And if Chipotle's on its way down, let's make some money on it.
I mean, look, any of the names that I have in the portfolio right now, Google, love it. Celgene, love it. Bristol-Myers, love it. Ford, it's stupid to me where Ford is priced right now. It's mispriced because car sales are fantastic. The earnings are good. They're paying out a special dollar dividend to people. I mean, it's ridiculous. Las Vegas Sands, Ralph Lauren, Verifone, Symantec, which we just added, which is doing really well. It's down a little bit, but nothing. We have great names in the portfolio right now. So
those are some blue chip names. I mean,
if it looks like we're not going to hang in here, then the one thing I may do is I may buy puts to protect any more downside. But I can live with being down 8% right now. When I think the potential really is a median return off of a year like last year where we finished down 3 to plus 3, it's 14%, and the average return is 18.5%.
Even if you look, Jeff, on an earnings yield basis, I think we're looking at next year something like 7.5 to 8% out of stocks. You're still looking at coupon yield of 2.5 on bonds with the probability of principal loss as rates go up. Commodities, what are we, maybe 3% in a good case?
And earnings so far have not been that bad. I mean, we haven't hit big earnings, but we've had now a week and change of earnings, and they've been decent so far. So, I mean, the one thing that's a problem are the banks. I don't own any banks right now because everyone thought that rates were going to go up, and then the banks are going to make more money, and now it's becoming apparent.
And I also think they were scared as the oil prices come down, some of the banks that had exposure to the oil sector are going to get hit. But I think that's the margin.
There's a rumor going around that one of the big banks has got some potential issues with this, but that's not going to play out for another 6 to 9 months as hedging stuff comes off. So we'll have to see. Yep. So kind of moving from that, I did 2 trades in options index trader last week. I closed one last week, made 28%, and then I closed one this morning, made 15%. So I feel pretty good about those 2 trades. They're SPY trades. I'm looking to potentially put another one on today. I mean, I came in on Friday, and when things were just nasty near the low and got in, and by Friday afternoon it was a winning trade, and it added on this morning. And I just felt like things weren't hanging in there as well, so I gave up on that. And we had a trade we did last week in Golden Energy Options Trader where we had a straddle, so we bought a put and a call at the same level on Exxon and made about 10% on that trade, so that was a good trade. And so we feel pretty good about where we are right now in terms of those positions. I'm looking to do some. I'm looking to do some more stuff because we're volatile.
Yeah, volatility can be your friend for sure.
So I think all the portfolios have been pretty good. I'm not willing to step in and buy stocks yet, but I'm willing to do the option stuff because I think that makes the most sense. I intend to do more trades this week, and the fact is, you put up 1 or 2 trades a week where you're making somewhere between 15 and 30, 40%. That's all you got to do, week in and week out. Just kind of, just wait for your opportunity and be patient, and you'll be rewarded. Like today's been a wild day. I've been watching. It's just been a very weird day. We went above with gap open that kind of failed, but we've been above and below resistance a couple times on the intraday Erlanger value lines, and we've also keep hitting this 2-hour low and kind of the prior day's 2-hour high. Excuse me, the prior day 2-hour high. We keep hitting that level and bouncing off it, which shows you the machines are in charge.
Yeah.
So not the individuals, and we need to see how that kind of plays out. So market crash, I'm still 25% cash. I'm not willing to go at this point to 50%. I don't think it makes sense, or even 100%. I really think we'll hang in and start to recover from here because I just think this has been way too much damage right now.
Well, I'm going to hit you with the same question as we close up today that I was asked on Newsmax television. By the way, you can see my Newsmax interviews at safefinancial.org and at stevebeeman.com. But Jeff, they said to me, of the candidates out there right now, Republican and Democrat, who do you think is the one most likely to be able to work with Congress and put in place the structural fixes our economy needs?
And the answer is, I don't think any of the existing candidates are going to become the potential final the final candidate that runs as a Republican or Democrat. I believe we're going to go. First of all, I believe Hillary is going to have to drop out because the FBI wants to come after her, and they're pressuring Justice. Justice ultimately reports to Obama. The Obamas don't like the Clintons,
Yep.
so I think it's a natural that he's not going to give her the hall pass this time, and she might have to drop out. The Democrats are not going to allow Bernie Sanders to be the nominee.
You think Biden might step back in?
Yeah, I think it's going to be Joe Biden. And then on the Republican side, no one's going to get it. They're not going to let Trump be the candidate, and potentially Bloomberg is now throwing his hat in the ring. And I can see a brokered convention on the Republican side as well.
Mitt Romney.
And my pick would be they asked him to be Speaker of the House, and now they're going to ask him to run for president. So Paul Ryan.
Well, what can you say to that? There you go, folks. The prognostications of permanent place. I don't even know what to say. Jeff, if you're right, I'll buy you a beer. It'll be kind of fun.
What were your predictions?
I said that, first of all, throw out the left. They don't have anybody that's got anything remotely close to the prescription our economy needs to get better. On the right side, I think you've got Cruz, he's not viable. He's too far to the right. The normal mainstream Republicans won't support him. Rubio doesn't have a chance. I think you go down the list. The only one up there who does have a conceptual chance is Trump. And to your point, the institutional Republicans are going to cringe with that as a solution.
Well, he doesn't espouse Republican platform. The Republican platform he does not espouse at all.
Not at all. I agree.
I do think there is a chance that a brokered convention also they could give it to Jeb Bush, which would be fine by me. I actually am fine with him being president.
I think it would be interesting. I mean, who's going to know? But it certainly creates interesting sport as we go through the year. Well, Jeff, thanks as always for being with us. And again, folks, visit Superstock Investor on the web. They have some of the best, really high-grade research that you can use, and they offer newsletters that are not expensive by any stretch of the imagination, but can help you as you journey on your path to real prosperity. Always visit safefinancial.org for the archives of these interviews, and visit me at stevebeeman.com for some of the articles I write around the world. Thanks so much for being with us, and we'll see you next week as you have a very prosperous week.
Thanks again, Steve.